Hi, this is Jonathan Miller, and welcome to the What It Means podcast. Today is July 22nd, 2025, and the title of this uh, discussion is Technology in the Housing Hype Cycle. Uh, but before we get into it, for those of you that don't know me, I am the co-founder and CEO of Miller Samuel. Started out about 40 years ago. Author of the Douglas Elliman Market Reports for the last 31 years. I teach market analysis at for the MRED, Masters of Real Estate Development grad course at Columbia. I've been doing that for about 7 years. And I'm the author of Housing Notes, which you can find at housingnotes.com, and I've been writing those for about 11 years. So if you can say anything about me, I'm certainly consistent, where I tend to do things until I almost drop dead. Um, but I want to cover sort of a broad array of topics today. I want to talk a little bit about the results of the 14 Florida housing market reports that we released last week with Douglas Elliman. I want to talk a little bit about interest rates and the Fed chair. I want to talk a little bit about, and this is sort of the biggest part of the presentation, I want to talk about technology. We went through, if you recall, 4 or 5 years ago, an iBuyer hype cycle. And now we're going through an AI hype cycle. It's not meant to be critical of AI. It's just there's a lot of overpromising and under delivering, at least at this time, which I want to touch base on in the context of how you see yourself in the real estate industry over the near future. The first thing is to touch on the Florida market, and generally the theme across Florida. If you follow social media, you get this impression that inventory is just exploding. It's the biggest in history. Um, and it's really not. Inventory is up about 20% year over year, which is a large increase, but it's still below long-term highs between 10 and 20%. We are seeing an evening out, the Gulf side and the ocean side. For the last year or two, there's been a lot more inventory coming up on the Gulf side. Really, the ocean side and the Gulf side are about the same now. What is an interesting pattern for those of you that are active or follow the Florida market is one of the patterns, and this is a seasonal pattern, which is something that sort of confirms that housing in Florida is attempting or seeming to normalize. And what it is that we tend to see inventory, while you would think it would peak in the second quarter, it actually peaks in the first quarter consistently across almost every one of the 14 markets that we cover. And it's not that inventory doesn't increase into the second quarter, it's that sales increase and reduce. So the net effect is that inventory tends to be a little bit less, about 10% less than it is at the peak, which is earlier in the year. And the fact that inventory has trended lower, consistent with the last decade of trends, tells me that sales activity is doing its thing. It's burning off the supply that comes in the at the the first 3 or 4 months of the year. The other thing that was interesting, for those of you that follow my work in Manhattan, where Manhattan in the second quarter hit a record. Uh, Almost 70% of the buyers in Manhattan were cash, which is the highest we've ever recorded. The long-term average is about 50%. Cash is also a powerful purchasing tool in Florida. On the ocean side, it's interesting. The ocean side is seeing more use of cash than the Gulf side, and even more than inland. So the numbers in the second quarter, generally, Oceanside market share of cash buyers was 63%. And that's not a record, but it's sort of bouncing along a high, elevated level, but it's certainly not the highest we've ever tracked, but the highest isn't much higher than that. Um, and on the Gulf side, it's 48%. So it's just under 50 versus just over 60 for the ocean side. And then inland, which are just a few markets that we track, like Wellington and Weston, it's about 38%. Um, and and the way to think of this, at least the way that sort of how to correlate it to make it make sense, is that generally the highest priced housing markets are found on the ocean side, and the Gulf side are uh, generally less expensive than the ocean side, and then inland is a little bit less than the Gulf side. So it kind of makes sense. I correlated this. I wrote about this last week. I believe it was last Friday. I've got some extracurricular charts in there that aren't in the study that you might be interested in. Um, but that's the take for the general take for what's going on in Florida. Uh, Now I want to start getting into a little bit of technology talk. Uh, I think some people happen to be love the bleeding edge of technology. They want to be the first people in. They want to, understand it and play with it. Um, and and it's called the bleeding edge because sometimes it's painful when when you're working with software that isn't fully sort of sussed out. Um, the way I think of it is when I was younger, man, I updated software immediately. I got the latest you know, phone. I got the latest computer constantly, always updating, updating, and updating. Now, when there's a new update for my iPhone, I might wait a couple of weeks to hear, maybe Apple has to come out with a couple of patches to make things, maybe less troublesome. I'm still very interested in being early into the the new technology, but not on the bleeding edge, and that's sort of been something that I've learned over time the hard way. Um, I wanted to talk a little bit about so go back in time a little bit about the iBuyer phenomenon and then relate that to what's going on right now with artificial intelligence or AI. The iBuyer and being a total Mac nut and originally building our company, Miller Samuel, based on Macs when there was no software for appraising, um, we really, were sort of at the bleeding edge of that experience in our appraisal practice. Um, but one of the things I just remember is first of all that iBuyer I used to think stood for internet buyer, um, and that would make sense anyway, but it really, as far as I can tell, stands for instant buyer. And a friend of mine uh, who had read my post was giving me some clarity on what I was trying to say, and I thought this was an interesting way to look at it. The real estate brokerage industry, when it comes to pricing, it's set up to achieve the maximum price, but it lacks certainty, meaning that you've got, you know, uh, you know, how long is it going to sell? Will it sell? Is the market going up or down? But the focus is to get the highest price for the property owner. That's what it seems to do well. On the buying side, it's just the opposite. The price is secondary, but what you are getting as a customer of an iBuyer is certainty that they're going to buy your house. You may or may not get the price you want, but they're going to buy your house, and that's the certainty. And that's, and there's always going to be a niche for that. One of the problems I remember, I used to be president of an appraisal association. I'm still active. They're called RAC, Real Estate Relocation Appraisers and Consultants, and we meet in Dallas every year. And we saw a presentation by Open Door, which was one of the early wave of iBuyers, and it was impressive. And I remember thinking, this is going to affect my business because a lot of the properties that maybe the buyer would go through a bank and an appraisal would be done are going to an iBuyer. And I remember interacting with the brokerage community at this time and my appraisal colleagues, and it felt like the brokerage business was going to be cut in half, and iBuyers were going to be 50% of the market, and everybody was panicking and thinking about it. And that's the hype cycle I was referring to. It's technology, and you press a button and everything is going to solve your problems. I love technology, but oftentimes when it clicks for a consumer, they're all in, and everybody is thinking that, this is it forever. This is the way it's going to be. And and so there was this sense that it was going to be half of the business. Maybe some people didn't get the same feeling that I did, and maybe it was less. But today, the market share of iBuying, as far as I can tell, is about 1% of residential transactions. It's not even close to what it was. And at its peak, which is circa 2021, it was 2%. Now that's across the US. But the markets where the iBuyer phenomenon has done the best, or done the most transactions, are markets like Atlanta and Phoenix, which are very, let's call them, homogenous, meaning that the housing stock doesn't vary a tremendous amount, and there's a lot of subdivisions. Las Vegas would be another example of that. There's a lot of sort of, similarities across the housing stock, and that makes it easier to value automatically. The reason why I say 2021 was sort of peak iBuyer was because that's when, towards, later in that year, Zillow offers imploded. They lost something like $881 million, and they pulled back, and they were using the Zestimate, which is something that I've told before on this podcast. But just to sort of highlight the key point is that if your if there's a Zestimate done on your house, the national accuracy rate, median accuracy rate, and I say median in air quotes because the median accuracy rate is 2%, but that's only if it's listed. That means half the time, if it's listed, it's within, the Zestimate is within 2% of what it ultimately sells for. But it could also be the other 50% of the time it's not within 2%, which could be anything. It could be 110% off. And if it's not listed, the median accuracy rate is 7%, which means that 50% of the time it's within 7% of what it sells for, and 50% of the time it's not. So they use that, and to do, to estimate values. And I used to hear scuttlebutt on the ground, people saying, yeah, I'm going to Zillow or Zillow offers because they're going to overpay for my house. And sure enough, they lost almost $1 billion by doing that, and backed out. And a player, portal like Redfin also pulled out, and Zillow and Redfin were only in because Opendoor and OfferPad were there first, and there was a lot of hype. They were sort of sucked into the hype cycle as well. Um, and so now there'll always, I think, be a need for iBuying, uh, where people just they're not nuanced about what they want. They just want a chunk of money for their house and they want to move on or move or be assured. And that's what iBuying provides. Um, this brings me up to artificial intelligence or AI. First of all, we're clearly in a hype cycle. I use AI all the time. Uh, I use it for, well, before I go into that, what is AI? Uh, the AI that everybody thinks is AI really isn't AI. ChatGPT, Gemini, I use Perplexity. Um, Claude is a Microsoft um, large language model. And that's the hype cycle. The list of names that I just presented are not really they're not it's not technically artificial intelligence. It's sort of related, but it's a large language model. And all it is doing, it's not smart. All it's doing is telling you what it thinks the next word in the sentence is. That's literally what it is. And it's very useful, but it should never be used without verifying. Um, I've seen some public stories about lawyers that use ChatGPT to write a brief, and then it was determined that the brief was completely made up and the cases they were citing never existed. But it has a tremendous there's a lot of ability there to automate um, elements of the brokerage business, of the valuation business, for sure, especially on the clerical side. Um, and I'm not anti, uh, AI at all, but again, from what I've learned in the past, I wouldn't be wildly, overzealous about its capabilities yet, although it is a net positive, I think, for the real estate industry in general. Um, one sort of evidence after I wrote a post about this last week, uh, there was a Wall Street Journal story that came out that uh, SoftBank and OpenAI had teamed up for a $5 billion AI project, and they're struggling. They're having a hard time getting it off the ground. And if you remember hearing SoftBank before, they're the mega $1 billion investment group that funded WeWork. And the trademark about WeWork is they never really looked at the details. They just went with their gut. And they're sort of the people that create unicorns, people that are institutions that are, require large amount of funding and are there to dominate a segment of the market that they're working in. And the track record of unicorns seems mixed to me. Um, and I'm not pretending that I understand all of it. I just know that when I see a SoftBank name behind something, I think of WeWork. Uh, Maybe that's not fair. But the fact that they're struggling with their $500 billion investment to sort of get off the ground, and I've listened to a couple podcasts uh, over the last week and read a bunch of articles about the hype cycle in AI and the massive spending. I mean, for goodness sakes, many of these AI firms are talking about starting up nuclear power plants to sort of um, generate the electricity that's needed to run these things. So again, this is beyond my expertise, but let's say as a seasoned older appraiser and somebody that's been embedded in real estate. I think AI is here to stay. I think it will provide significant influence and contribution. But on the other hand, I wouldn't panic about being left behind in the way that is being conveyed right now. That would be my take. Um, and I think that's probably all the takes I can give you today with the time I have. But I wanted to thank you. You know, we talked a little bit about Florida, iBuying technology. Oh, the one thing I wanted to just mention, I promised at the beginning of the podcast, I wanted to talk a little bit about rate cuts, and what we've been hearing. As you know, in past podcasts, I've talked quite a bit about tariffs and how they're really a tax on the American consumer. And whenever you hear conversations about the administration, raking in billions of dollars from the tariffs, that's actually coming from the American people, the American taxpayer. Tariffs are a tax on the consumer. And that is, we're just last couple of weeks, we've gone through another round of random tariffs being, thrown about, coming out of Washington. And the other point I had made was that um, that it's becoming a certainty that there's a lot of uncertainty, and that there will be a lot of uncertainty going forward for a while. So what you have right now is a situation where the Washington, or the administration wants to uh, cut the Fed rate, um, uh, to cause mortgage rates to go down. And I wish it were that simple, but in fact, there's been calls by the president to cut rates by about 300 basis points, or 3%. Um, and so there's a couple problems with that. One is we still have a pretty strong economy. It is weakening, but unemployment's very low and wages are elevated. And what's going to happen is if you were to bring interest rates down dramatically, for me, a dramatic cut is like 50 basis points. 300 would be incredible. And what that would do is create runaway inflation. If you think interest rates are high now, wait until there's a 300 basis point Fed cut. You will, in my belief, you will see significant, or the potential for significant inflation, which is counterproductive to the housing market. Goldman Sachs yesterday just announced their forecast of three Fed cuts in the remainder of 2025. Bank of America, I believe, is one cut. So there's a lot of conversation out of Wall Street that there's, but somewhere between one, mostly two cuts, as high as three with Goldman, in the remainder of this year. Excuse me. That does not mean that mortgage rates will fall significantly. Mortgage rates seem stuck at just below 7%. Uh, and in many ways, we've seen a big increase, an uptick in mortgage applications, according to the Mortgage Bankers Association. And I think just the fact that rates have been stuck at a similar level, and just short of 7%, is starting to get people that have been waiting back into the market. If we're looking at a housing market, any housing market in the country, as I always say, housing is local, but mortgage rates are national. And we are seeing more mortgage applications trickle in, still underperforming, but we are seeing a little bit of a change. So I don't, even though we're talking about rate cuts, I'm not anticipating a significant drop in mortgage rates in the back half of 2025. because and to throw another sort of monkey wrench into it, the administration, namely the president, is feuding with the Fed chair, calling him every name in the book and saying that you need to cut rates right now. And the Fed chair isn't doing that because that would trigger a lot of inflation, which is our enemy, basically. But he is talking about putting in a sort of shadow chair, either firing the Fed chair that he appointed or putting in a replacement, or having somebody approved and ready to go and sort of behind the scenes, presumably speaking in public a lot. A couple thoughts about that. One is that the Board of Governors, there's a there's a dozen governors, and they're not all being replaced. And they're not, if someone came in and said, hey, we want 3% cuts, it's unlikely. The Fed chair doesn't have that kind of power. They are there to influence, and they do have some impact, but they're not in charge in the way that the argument seems to be going. The other thing is that the whoever is nominated to be Powell's replacement in 26 is going to go through grueling confirmation hearings in the Senate. And so it just seems like you're going to get somebody pretty qualified. It would be hard to find somebody that wasn't, you know, qualified to get through the Senate. Who knows? But I'm just skeptical. And in fact, when you sort of confirmation of this is when you read lately about all the different Fed cuts. I mean tariffs that are being thrown out, like uh, there's a tariff being thrown at um, Brazil, and Brazil has a trade surplus. They don't have a trade deficit with us. And as a reminder, what a trade deficit is when you go to the grocery store and spend $200 on groceries, you now have a trade deficit with the grocery store. And the administration is basically saying that you're being screwed because there's a deficit because the grocery store isn't buying $300 or $200 from you. It's very bizarre. So as a result, Wall Street, we're not seeing the volatility anymore. After tariff announcements, it's being ignored, and that's the way the sort of economic system is sort of coping with the randomness of the tariff announcements. Um, so hopefully that continues. I think what the consumer wants to see is stability, and not sort of, you know, wild swings in strategy or moves every day. It's unsettling. And the last point I'll make is, we're in this era of uncertainty. The consumers feel it, you feel it, buyers and sellers feel it, and I think it's here to stay. And that in itself is a certainty, sort of like what the stock market is doing, um, with not really reacting to the wild swings in sort of tariff announcements, and the lack of really any agreements with the 90 agreements that don't really exist. We're sort of in uncharted territory, but the financial markets aren't panicking or moving around. So I would probably take the same advice, and I'd probably speak that way to your customers if you're a real estate agent. The uncertainty is a certainty now, and probably you just need to move on. Uh, and hopefully that makes sense to you. I hope that you've got something out of this today. And if you have any questions, you're always welcome to email me. My email address is jmiller@millersamuel.com. I get a lot of feedback from these broadcasts, and I'm happy to learn what your perspective is. But in the meantime, uh, in light of you spending your valuable time with me, I want you to remember always that pi is better than cake.